So, without wasting any time, we shall begin with the session. And we're how much? We're having around 250 participants. Okay, just let me know like if I'm audible to all. Just mention in the chat box if I am audible to all. Okay. Okay. So yeah. So we have around 250 participants joined in from the different Zoom calls, and I'll be just sharing my screen. Just let me know if my screen is visible. A very quick topic for today, a unique and interesting one. Is regarding the working capital and the return on capital employed. Though we have talked about working capital and the return on capital employed in the isolation in the previous sessions, and we have talked about them separately and went to the deep analysis for both of these concepts, be it ROCE, the working capital, and further the ROE as well. But this is something in which we're going to try to establish a relationship between the ROCE and the working capital. So first thing for all, we know that what is ROCE. So I'll be just going quick on this definition because we have talked about ROCE and ROE in detail. That what exactly is the difference between the ROE and the ROCE. Just give me a second. I'll just increase my audio. Correct. So ROC, we know the formula is basically states your earnings before interest and tax, that is your EBIT, divided by your equity and debt. So equity and debt is nothing but your total investment into the firm, and your EBIT is your earnings before interest and tax. And while in the case of the return on capital employed, we tend to take into consideration your EBIT because EBIT is the profit that is available to both the shareholders as well as the debt holders. I'll repeat this point that whenever you are talking about this EBIT, your EBIT is something that is available to both the equity holders as well as the debt holders. And as the name suggests, the return on capital employed, it is the total return to all the capital providers of a firm, be it the equity holders or the debt holders. Everyone who has contributed certain capital into the firm, be it the equity providers or the debt providers, everyone is getting some return. And that is why we have taken into consideration EBIT and not PAT. PAT is something which is the profit after tax, and that is something that is available to the shareholders only because all the interest payments have been paid off and tax has been paid off, and whatever is left is available to the equity providers of the company only. But when we're talking about this ROCE, the return on capital employed, it is a return that is available to both the equity holders as well as the debt holders. So that is one concept which we have talked about already. Coming back to the second thing, we have something called as working capital. And ideally, when we talk about the working capital, we tend to talk about the net working capital because something we have as a gross working capital, and the second aspect that we have is the net working capital. The gross working capital is nothing but your current assets. All the current assets that the enterprise has is your gross working capital. But when you subtract your current liabilities from the current assets, you have the net working capital. So here you have your current assets minus your current liabilities is the net working capital. The total or the summation of all the current assets in the balance sheet of the company, subtracting the total of all the current liabilities in the balance sheet of the company. And the difference between the current assets and the current liabilities, we tend to get the net working capital. So that is something, the one scenario that we have. Ideally, a business always wants, or ideally, like when we study about this concept of net working capital, we ideally want the current assets of the company to be always more than the current liabilities. Because if the company has a lesser amount of current assets as compared to current liabilities, in that scenario, it might be difficult for the firm to pay off its short-term liabilities, right? There might be some expenses, there might be some short-term obligations that the company has to pay. In that case, the company must have sufficient assets, or the company must have sufficient liquidity in the form of the current assets being more than current liabilities so that the current liabilities can be paid off, right? So that is one scenario which we ideally expect. But one thing we need to understand is that there can be some corporates where this ratio, not the ratio, but the difference between the current assets and the current liabilities is negative. And the companies enjoy this difference. Ideally, we have always studied that the difference between the current assets and current liabilities must be positive. That is, the current assets should be more than current liabilities. But most of the companies also prefer a negative working capital. And what do I mean by negative working capital? The negative working capital is nothing but when the current liabilities are more than current assets, or the current assets are less than current liabilities. So in this case, the difference would be negative. The company has more of current liabilities and less of current assets. So that thing we need to understand. Is it really good? Or what are the positive aspects of this difference being negative? Why do the companies also prefer this difference of current assets and current liabilities being negative? So that we need to understand. And how does this impact the ROCE of the company, or the return on capital employed? And further, how does it impact the cash flow statement and the valuation of the company? So that we need to understand in a very simple parlance. So before we try to understand the impact of the negative working capital or the positive working capital per se upon the ROCE of the company, or the cash flow statement of the company, or further the valuation of the company, let's try to understand one equation. The balance sheet equation ideally is comprised of what? The balance sheet equation is ideally comprised of, and we know this balance sheet equation, right? Your assets is equal to liabilities plus capital, correct? And that is the basic accounting equation in finance that we talk about. Assets is equal to liabilities plus capital, right? If we further try to break down this equation, we can talk about your fixed assets plus current assets, because ultimately your assets are comprised of what? Your assets are comprised of your fixed assets and current assets. Your intangibles, tangibles are a part of the fixed assets. Long-term assets, long-term investments being a part of the fixed assets, and all your short-term investments, cash equivalents are a part of the current assets. So fixed assets plus current assets is the breakup of the total assets part, is equal to your liabilities plus capital. So what do we do? The capital, we have nothing but equity plus debt, because the company can have what? The company can have all those kinds of liabilities in the form of equity and debt. Equity is nothing but the shareholders fund, and debt is all the long-term liabilities, right? And this L is nothing but your short-term liabilities, because if all the long-term liabilities have been covered in debt, so what is left is your short-term liabilities. So that is nothing but a simple balance sheet equation of assets is equal to the liabilities plus capital being broken down into assets being a part of the fixed assets and current assets, and the liabilities being broken down in the form of short-term liabilities, and your capital being broken down in terms of equity and long-term debt. So that is the basic balance sheet equation that we tend to talk about, right? Further, how can we derive? Okay, if we tend to talk about, and we also know that ROCE is your earnings before interest and tax, EBIT, divided by your equity plus debt, correct? So how can we derive this equity plus debt? So your equity plus debt is nothing but, if we tend to shuffle these numbers, equity plus debt is nothing but your fixed assets plus your current assets minus current liabilities, because your short-term liabilities are nothing but your current liabilities only. So we know that equity plus debt is equal to your fixed assets plus current assets minus current liabilities. Further, we can say that your capital employed, which is of course the summation of the equity plus debt, is your FA plus then working capital, because CA minus CL is a working capital, correct? So further we can say, if you are talking about this ROCE, which is EBIT by E plus D. So instead of E plus D, we can substitute this number, fixed asset plus working capital, right? So what does this equation ideally turns out to be? If I just erase all this, because it is just about breaking down the numbers and trying to understand the stuff in the simplest way. So we got to know that equity plus debt is nothing but the fixed asset of the company plus the working capital. And ROCE is nothing but your earnings before interest and tax divided by your E plus D, that is your total capital. And E plus D we can substitute as FA, the fixed assets, plus the working capital. So the new equation of the return on capital employed, it turns out to be your earnings before interest and tax divided by your fixed assets plus working capital. And this comprises of the changes, the CA minus CL, correct? So we always know that when we write such an equation, the denominator is always inversely related to what do we want ideally. The basic rule of mathematics, like when we study about fractions, right? Ideally, we tend to say A is equal to P by Q, correct? And Q is always inversely related to A, and P is always directly related to A. And the same logic stands here. This denominator is always inversely related to the ROCE. It means if the working capital rises, ignore this fixed asset component as of now, right? Because we know if the fixed asset rises, that is your investment in the fixed asset rises, the ROCE comes down. Why? Because the denominator rises. Because when you talk about ROCE in layman's language, it's nothing but your EBIT by your total investment. If this investment is rising, if this denominator is rising, mathematically the ratio will come down, right? And this logic, we know it. If there are more investments, the ROCE will come down. But here, if we talk about the relationship of ROCE with the working capital, if the working capital is rising, and when will the working capital rise? The working capital will only rise when the current assets is more than current liabilities, right? In that case, like we'll be having a positive number. So if the working capital is rising, the ROCE is falling. Just make a note of this point. If the working capital is rising, the ROCE is falling. And I showed it with this practical example by breaking down the numbers, a kind of a good derivation of making you understand these numbers. So ideally, we always know, and people also focus upon the higher ROCE. Ideally, investors, fund managers, and mutual fund companies are focusing towards those stocks which have higher ROCE. So how can a company achieve higher ROCE? The one way can be to reduce the fixed assets investments or simply the fixed assets, or to reduce the working capital. Ideally, we always want the working capital should be as high as possible. But if the company is reducing this working capital, or this working capital is becoming negative, this ROCE will still rise. So we need to understand this scenario because we always take into aspect the fixed assets component in relation with ROCE. Now from today, we also have to start looking into the working capital changes, like with respect to the ROCE. It can also happen that the working capital is falling, the working capital is negative, which of course is not good because that hampers the liquidity constraints of the company, and the ROCE is rising, which is not a good scenario. Ideally, be it the fixed investments, being the working capital investments, the ROCE should still be in a reasonable stage, at least like 13 to 14%, ideally, as we call in terms of corporates, right? So the working capital always has an inverse relationship with the ROCE. EBIT has a positive relationship with the ROCE. Simple mathematics, fractional logic. Okay. So here, this is the impact upon the ROCE. Now let's try to understand its impact upon the cash flow statement. We all know in cash flow statements, any increase in the assets, your working capital changes. When your working capital is increased, or your increase in the working capital, right? Which means current assets are more than current liabilities, right? When the working capital increases, it ultimately states you the current assets are more than current liabilities. And if there is an increase in current assets, that is subtracted in the cash flow from the operating activities, right? So overall, whenever there is an increase in working capital, that would be subtracted from cash flows, correct? Whenever there is an increase in working capital, that would be subtracted in the cash flows from the operating activities, correct? So when that cash flow is subtracted, the quantum of the cash flow or the volume of the cash flow comes down, and hence the valuation is also affected and the valuation comes down. Because if the cash flows are less, the valuation will come down because ultimately these cash flows which we are trying to project for future, and discounting those cash flows to get to know the intrinsic value of the particular stock or share right now, that cash flow is going down, so ultimately the valuation will also go down. So higher working capital, which is subtracted from the operating cash flows, it can affect the valuation of the company, and it can make the valuation of the company appear low. But if you have a negative working capital, that is, if the working capital is falling, in that case, it is added to the cash flow from the operating activities. But just make a note of this point. A positive working capital is always subtracted from the operating activities in a cash flow statement. That reduces the total cash flows and the valuation of the company. But when you have a negative working capital that is added to the operating activities in the cash flow statement, hence the cash flow rises and the valuation also rises. So the companies might prefer to have a kind of, I would say, a negative working capital so that their cash flow rises and the valuation also rises. So one way to increase the ROCE is to have a negative working capital. And one way to increase your cash flows and having a higher valuation is again to have a negative working capital. So that thing we need to understand. If this is happening, we need to pay special attention upon the managements and the financial numbers of the corporates. So that is one thing which is very well important to know. That is one logic, as I just told you, for the ROCE impact and all these things. Just let me know if any questions till now. Yes, Raghav. Yes, EBIT will always have a positive relationship with your ROCE. Investment in the fixed assets will have a negative relationship. Yeah, because we always have been talking about the fixed asset scenarios every time, right? So now it's time to take into consideration about the working capital investments needs also. Right? So that is one thing that we need to understand. So I'll just wait for a minute or so, right? Start with like one more quick interesting topic. If no questions, we'll begin with one more interesting topic. And these are something which I'm trying to explain from a different perspective, which you won't find in books and like the other kind of YouTube videos. Right. So make a note and I'll be just sharing the recording of this session as well. The next topic is, and I want the answer in the chat box. You have two things. One is your gross debt and the other is your net debt. The gross debt is something which is the total component of all the liabilities of the company. And when you subtract your cash from the liabilities, that's your net debt, right? Now it can happen that your net debt, it might be negative because the cash is too high, or that the net debt might be a positive number. For example, if the company is having 100 crores of liabilities and the cash that the company has is 50, your gross debt is 100 and your net debt is 100 minus 50, that is 50, right? So your cash is nothing but your cash amount in the financial statements of the company. Simple. Now just tell me in the chat box to everyone, to all the 250 participants who have been joined in, when we are analyzing the financial metrics of the company, should we look at the gross debt or the net debt? Should we focus upon the gross debt or the net debt? Put your answer in the chat box. I can't allow you to unmute because there are 250 participants and that will create a fish market. But mention in the chat box. Will you focus upon the gross debt or the net debt? Gross debt, gross debt, gross debt, net debt. The majority of the people say gross debt and a few say net debt. The correct answer is gross debt. Because what basically happens, see, when you are trying to calculate your net debt, it's your total liabilities minus the cash the company has. Now, it is not mandatory that this 50 crores of cash will be used to pay off the debt only. It is just a cash amount on the balance sheet of the company, just a cash amount. It can be used for any of the purpose. That cash is not just to pay off the liabilities. The cash can go off anytime for some merger process, some acquisition process, some kind of expenses, right? So always look at the gross debt because this cash, though useful, is not meant to pay off these liabilities only. It can be used for the other activities also. That is why always look at the gross debt of the company. One common interview question. Now, there is a ratio called as your debt by total capital. And then you have something as your debt to equity. And then you have something as your debt to EBITDA. The earnings before interest, tax, depreciation, and the amortization. So what is the difference between these ratios? Anyone? Just tell me, how is debt to capital different from debt to equity? Debt to EBITDA, I won't be forcing you because that might be something new for you. But what is the difference between debt to capital and debt to equity? See, like whenever we are talking about debt to equity, it is the total debt of the company divided by the total equity. And we always want this ratio to be as low as possible, right? Debt to equity ratio. And this debt to equity ratio is also used to calculate your leveraged betas, right? I've talked about the difference between the levered betas and unlevered betas. Levered beta has the component of debt. And the unlevered beta do not have the component of debt. In CAPA model, you are using that levered beta. How to calculate that? What is the difference? I've talked about the same in my modules and previous live sessions as well. So I won't be focusing like much more upon that concepts. But if you still have queries, feel free to ask me. Okay. But when you're talking about the debt to capital ratio, your debt to capital ratio is something that is used to calculate your cost of capital or the weighted average cost of capital, as we talked about in the cost of capital sessions. Your debt to total capital, that is your debt as a percentage of the total capital. That is the weight of debt into the cost of debt plus the weight of equity into the cost of equity. So a debt to capital ratio is used to calculate your cost of capital, and your debt to equity ratio is used to calculate your levered betas, the betas that have leveraged. And then you have something called as debt by EBITDA. What do you mean by debt by EBITDA ratio? So sometimes if you want to know how much cash the company is generating from the cash flow aspect, right? So if you want to know everything from the cash flow aspect, how much cash the company is generating. I know my screen has a stop to get shared like due to some technical backdrops. But the thing is, if you want to know how much debt by EBITDA, how much debt the company is able to pay off out of the cash flows it generates, right? So that is something which is your debt to EBITDA. And if that debt to EBITDA ka ratio is low, right, it means less leverage. It means your EBITDA is high and your debt is low. The company is less levered. That is from a cash flow aspect. But if this ratio is high, it means EBITDA is low and debt is high. That is mean the company is levered. So if you want to understand from a cash flow perspective, use debt to EBITDA ratio. That is something that we need to understand because debt to EBITDA is a multiple of the cash flow that the firm generates. Okay, so that is something that you need to understand. So today we talked about debt to capital, debt to equity, debt to EBITDA, working capital impact upon the ROCE, cash flow and valuations. And also we talked about the gross debt and the net debt. Any questions till now? Any questions, just mention in the chat box. If no more questions, just revise these topics for today and go through all the modules and aspects like which I've shared with you already, because these sessions I try to keep short and crisp so that all these new topics like which I have been taught today are much easier for you guys to understand and revise those. Correct? So, okay. So feel free to come back for any kind of concerns. Thank you so much and see you the next week. Thank you.